Ladies and gentlemen, FRASERS CENTREPOINT TRUST has finally confirmed that they will be selling off Changi City Point, and this is actually for 338 million. Well, ladies and gentlemen, are they finally doing the right thing after 4 years of severe mistake that cost shareholders severe underperformance of FRASERS CENTREPOINT TRUST? In today's video, this is what we're going to investigate in detail. Now, just look at the slide. Essentially, they mentioned that the manager intends to use net proceeds to repay loans with higher interest rates. But boy, in the first place, ladies and gentlemen, how is it that the manager lend shareholders, lend the REIT in this kind of dire straits that is actually landed up with higher interest rates? Well, you may say that interest rates basically went up in the last 1.5 years. You and I know, don't tell me the manager do not know, that if that's the case, why did they not prepare their balance sheet for this eventuality which ate into the earnings of FRASERS CENTREPOINT TRUST? That's what we're going to explore in today's video. Background, ladies and gentlemen, before we go into that, I just want to share with you, ladies and gentlemen, my encumbrances as well as basically experiences with FRASERS CENTREPOINT TRUST. I think many of you all know that I have been FRASERS CENTREPOINT Trust shareholder for a long period of time since their listing way back in 2006. You can see, ladies and gentlemen, this is the top shareholding of the FRASERS CENTREPOINT Trust, which I actually held. I was their 16th largest shareholder with 2.12 million shares. Look further, ladies and gentlemen, this was in the annual report of 2019. And once again, ladies and gentlemen, look at my book, which is actually published in 2000. I shared in chapter 9, Making Your Millions in Real Estate Investment Trust, why I sold off the 2 million shares above $3 in the early part of the year 2000. Now, this next slide, ladies and gentlemen, actually shows the times when I was their top 20 shareholder. This was actually in FY 2007 based on F06 when they actually first listed. Then 2014, 2015, 2016, right up to 2019, you see that I was listed as top 20 shareholders. In my book, in chapter 9 of Making Millions in REITs, you notice that basically I mentioned and I shared, as well as in our GCP Global Investment classes and various media interviews, why I sold off FRASERS CENTREPOINT Trust at above $3 in early part of 2000 before the share price plunge. So in today's video, this is the background and why I think that finally they have done the right thing in actually selling off Changi City Point. Now, ladies and gentlemen, let's look at how did FCT got it wrong in the first place. Now, the first thing, as you can see from the slide, that how did they got it wrong was because they failed to prepare for the huge surge in interest rate costs. And you can see that, remember, one of the explanations that they say in selling off Changi City Point is to pay off higher debt. Now, way back, ladies and gentlemen, in the beginning of 2021, just after the COVID, you notice that their cost of debt was 2.16%. And through the year 2021, it steadily or hardly increased. In fact, only 54 basis points when they ended the year at 2.2%. Now, come to 2022, when it was very apparent that the Fed will increase interest rates, how did they prepare the balance sheet? Well, very badly, as you can see. The management expanded like no homecoming. The cost of funds actually surged from 2.2% in the beginning of the year 2022 right up to 3.5%. Holy cow! And this was something that we have highlighted to the management, and somehow they have fallen on deaf ears. And so what happens? The share price plunge. So, moral of the story is that if you have a management that do not listen to shareholders, boy, be careful, as what FCT have shown. And you can see, ladies and gentlemen, that's one of the reasons why we have sold out of the shares as a major shareholder way before that. Now the second reason, ladies and gentlemen, is that you can see here, this is how the gearing ratio has actually done or fared for FCT. You notice that it was constantly in 34-35% level and through 2021, and in 2022 to 2022 and it steady was at 33% thereabouts. But of course that was actually because they had funds raised from the preferential shareholders offer, as well as actually a private placement. Now, of course, ladies and gentlemen, if you have listened to us and not take up the placement, whether it's secondary placement or the preferential offer, you will have made money because the share price, it has stayed below 220, has continued to stay below the placement price of 235 and 234 for the last 1.5 years. Think of the opportunity costs, ladies and gentlemen. And 2023, you can see this quarter, we rang an alarm that the gearing went to above 40%. And in our classes, GCP Global Investment classes, we have always iterated that those REITs, and we have done for you detailed studies, that those REITs that are stubbornly moving against shareholders' interest by expanding aggressively without due respect to the gearing ratio, doing disadvantages to shareholders, have suffered, and FRASERS CENTREPOINT Trust has actually gotten themselves into this. But just as a recap again, the increased waterway point, they are at the cap ratio of 4.6% thereabouts. Then they actually went to buy the PGIM portfolio. Holy shit, By doing so, they became the biggest land owner of retail space in Singapore with a 10.6% market share. But you as a shareholder of FRASERS CENTREPOINT Trust, did you actually benefit? No, man. Look at the chart again, ladies and gentlemen. You saw your share price down, down, and down. Right? Until recently, it was still below 220. Right? Wow. So, ladies and gentlemen, this is another advocate, that what we have mentioned in our GCP Global Investment classes, that is when REITs overexpand. You notice that this is a time, where, it is not in line. Or maybe to the extent, put it this way, the interest of a REIT overexpanding is actually more in line with the manager's interest because they earn an acquisition fee of 1%, disposal fee of 0.5%, rather than shareholders because they have to raise funds. And of course, no REIT manager will ever tell you their acquisition is bad. In the first place, they wouldn't do it. But in trying to sell Koyo to you, they will tell you that, wow, it's so good and so good. And you, as an astute REIT investor, you have to decide and understand way beforehand, as what I did when I sold off all my major shareholding. Whether those actually make sense, and basically in our GCP Global Investment classes, the next one is actually the 9th of September. So do join us if you want to be an astute REIT investor. In our class, basically, we're going to talk about the sell-off in REITs. Is the correction overdone? Revelations of REITs in the past quarter. Some of these are the things that we want to share, which we find very comical in the REIT market. Some of this we already shared on Manulife and Primary way in advance before the share price collapse. And then we talk about retail REITs other than FRASERS CENTREPOINT Trust. What is it like for the outlook for Maple 3 PAC and Capital Land Integrated ICT. Then we talk about the industrial REITs, and then we talk about office REITs. So do join us for our next class on the 9th of September. As I said, ladies and gentlemen, in my recent Business Times interview, I think the REITs basically have been sold off very badly. It's poised for a rebound. In fact, you can see that from my last video last week, you notice that I told you that I've been traveling. Now it's time to come back to really put serious money into REITs. The rebound coincidentally started to happen. As you can see, this last 1 week has been good. Will it continue for next week? Will it continue for the rest of the year? Well, do join us for our class next week to find out. Once again, have a great weekend.